Hi, I'm Quinn Nguyen at Intercom's the Oil and Gas Conference in Denver, Colorado. Joining me now is James Edmiston, Chief Executive Officer of Harvest Natural Resources. Hi, James.
Hi, Quinn. How are you?
I'm great, thank you. Now, Harvest has been operating in Venezuela through its equity affiliate, PetroDelta. What do investors need to know about PetroDelta and about the new windfall profits tax?
Great. Well, actually, Harvest has been in Venezuela since 1992, so even before the formation of PetroDelta, we're as far as a U.S. company, we've been down there longer than anybody on a continuous basis. The business transferred to PetroDelta into an equity company in 2007, 2008. So it's a joint venture between PDVSA, the state oil company, and Harvest. Harvest and its affiliates own 40% of the company, PDVSA owns 60%. It has a series of fields in adjacent to each other, 6 fields, about 9 billion barrels, certified oil in place, so very, very large scale. And really the task, the strategy of the business is to develop that production, continue to grow that business. Right now we're producing 35,000 barrels of oil a day, which is about 45% above last year. So very, very strong sequential growth, all fully funded within the company. You did mention the windfall profits tax. There was a modification to that tax that occurred in the spring of this year as oil prices went above $100 a barrel. So that tax kicks in roughly on a WTI basis of $80 or above. The effect of that was a minor reduction of our margins. Our margins in the business are very, very strong, $25 to $30 a barrel after tax. So it took about, at $100, it took about 12% reduction in margins, still mid-20s, very, very strong. I think one of the important things to note is in the past week or so, we've seen the market hit most of the oil companies pretty hard as WTI dropped from $100 a barrel to $80 a barrel. With that $20 a barrel drop in oil price, Harvest margins in Venezuela actually were only reduced 2%. So while it takes a bit of the upside away when you get to excessive oil prices, it also cushions the downside when you come down from $100 a barrel to $80 a barrel. But very strong business, very stout margins, very heady growth in terms of both production, reserves, EBITDA, cash from operations, and most importantly to us, it's all fully funding. We haven't had to put external capital in the business for quite some time. The runway for growth is outstanding.
Now, if any one of your exploration projects is successful, what could that mean to investors?
Well, actually, and we'll talk about 3 exploration projects. One in Gabon that we've just completed the first well, one in Oman, and the ongoing project we have in Indonesia. The simple fact of the matter is any of those projects have the scale and the capacity to exceed our current market cap. So if you look at any of those projects on a risk basis, which includes the risk of a dry hole, Oman and Gabon exceed our market cap, our current market cap by some margin, and then the Indonesia project actually can be much, much bigger. If you look at it on an unrisked basis, in other words, if we're successful at all 3 of these, you're talking about at least 10x exposure, or 10 times exposure to our current market cap just within those 3 projects if we're successful.
Now, you talked about some of your international assets, Oman, Indonesia, and also West Africa.
Right.
How can a relatively small company like yours manage all of this?
Okay, well, projects don't manage themselves, people do. And so, you know, while we're small, all of the people that make up Harvest, typically we all come from major oil company backgrounds, and we were executives with major oil companies. So the type of projects we're managing aren't any different than the kind of projects we managed before in our careers. We've got companies from Conoco to British Gas to British Petroleum to Tenneco to Oxy. All of these companies are the backgrounds from where our executives came from. So there's quite a comfort level within the people, within the talent pool we have in Harvest to manage these kind of activities and in the countries. As a matter of fact, we're not operating in any locale that we don't have executives that have actually lived in that locale and speak the language. So we're actually quite well equipped for this type of strategy.
Now, why did Harvest choose to sell the company's Utah assets earlier this year?
There's 3 reasons, and I guess there's an economic reason, there's a financial reason, and there's a strategic reason as well. So from an economic standpoint, if we look at the economics of going forward in that type of resource play versus our ability to sell it, and we basically elected to take about $215 million for it off the table. If you look at the economic case for keeping that, we probably could have generated a mid-teens type return going forward and would have had to invest a large amount of capital in order to do that. I don't think that those kind of returns are what our investors and shareholders look for from a company like us. I think they're looking for something much bigger. So that's the economic case. The financial case is we have an ongoing exploration program in Oman, Gabon, Indonesia, most of which we believe those had the ability to create more value for the company. We didn't want to issue stock or anything else, cause dilution to fund our exploration program. So basically by selling the Utah assets, which were generated from our exploration program is self-funded, which is quite unusual. I think the third reason is strategic. If you look at the company, we announced that we were involved in some strategic discussions about the company last September. If you look at the makeup of our assets, the major attractiveness of our asset base is our international assets, and certainly in terms of scope and scale, the Venezuela asset in particular. When you look at the potential buyers or interested parties for that group of assets, the Utah assets really weren't a great fit strategically for that. So it really cleaned up the portfolio in that regard. So the combination of those three reasons made it a pretty obvious decision.
What other insight about Harvest would you like to add?
I think that if you look at the group of people that make up Harvest, we've been together for quite some time. We're all owners in the company. To my knowledge, no officer's ever sold a share of stock, and we're pretty consistent buyers. We're excited about our future. This was a road we embarked on about 3.5 years ago to build the exploration side of the business, and we're at probably the most exciting stage where we've drilled one well in Indonesia this spring. We're drilling a second now. We drilled the well in Gabon with 2 sidetracks and had an oil discovery. We'll be drilling in Oman in the November-December timeframe, and that's following up on our success in Utah, where we went from discovery to sale for $200 million in less than 1 year. So this is a time that's very exciting for us, and it took a lot of work to get to this point. So I think that the catalysts that the company has to offer the shareholder over a very compressed period of time are very hard to match in this market.
Well, James, it's been a pleasure having you here today.
Thank you.
I'm Quinn DeWin for OilAndGas360.com.